Today, we're going to talk about life insurance. Now, is life insurance, is it an asset or is it a liability? Because there's a big difference between the two. Now, let's talk. What is life insurance to you? And what are some common things that you expect it to do for you? Now, you could own group coverage, you could have individual coverage, but there's a lot of different things that life insurance will do. Some of you have bought it because, you want to pay off a mortgage, you want to pay off your bills, you want to provide a college education for the kids if you pass away before they grow up. You want to leave money for survivors, you want to leave a gift to charity, you want to leave a gift to your church, you want to pass wealth into the next generation that's tax-free. You have to have it as an obligation to back up a line of credit. There are so many different reasons that you might have life insurance, but is it an asset or a liability? Well, there's a lot of things that factor into that. Well, let's start with who should own the policy. Now, I know this is something you may not even think about when you're writing down some of the things, but let's back up and let's talk about a couple of ownership scenarios. What if your employer owns the group life policy? Now, they are allowing you to use that. Now, the employer can change the carriers, drop the coverage, change the limits on it at any time. So you're just a participant. Now, in many cases, if you have additional group life insurance, you need to find out, is that coverage portable? That means when you leave the employer, are you able to take it with you, or does it expire at the time you separate? Now, this could be very important for some of you who have pre-existing conditions, or you've got some health issues that may make it hard for you to qualify for other coverage. So with your employer, make sure that you have got portability. Should you own the policy? Well, there are some things about a holy and an unholy triangle we'll get into a little later. But if you own the policy, then you have that as an asset of your estate, and you also have the ability to change the beneficiaries at any time. Should your spouse own the policy? Well, there's an interesting discussion about your spouse owning the policy on you, and then we come back to some of the beneficiary issues on that. If your spouse owns the policy, then it is not an asset of your estate because you did not own it. Should you have your children own the policies if they happen to be the beneficiaries? That's a great question. If your children own the policies, then again, it's not considered an asset of your estate. Should your business or business partner own the policy? Well, if you have a buy-sell agreement that's funded with life insurance, that could be an excellent idea to create the tax-free money to buy out your portion of the business at your death and have the ready-made money to do that. Should a charity own the life insurance policy? Yeah, let's think about that. The charity owns the life insurance policy. They get to control who the beneficiary will be, which in most cases will be the charity, to avoid the unholy triangle. And well, why would they do this otherwise? And they cannot get the coverage if you don't participate. So, don't worry that a charity is going to suddenly put a bunch of life insurance on you and hope you're going to die. You're a part of that process. But if the charity owns the policy, then at that point, they are looking at a significant legacy later. And again, it's not part of your estate. An unrelated third party, now that one, you've got to have an insurable interest before they will ever issue the policy. So depending upon the dynamics, an unrelated third party may not be allowed, in essence, during underwriting to have that coverage on you. Now, that could change in the future if you sold the policy to an unrelated third party instead of surrendering it. Most of the times, those are called a viatical settlement if you are expecting death to occur within 12 months. There is also living benefits that are done along those ways. Do you want to have a trust own the policy? Well, there are things called irrevocable life insurance trusts, and there are other mechanisms where we may want the trust to own the policy, again, because we don't want the insured to be the owner of the policy. All right, we've got the owners, that we've got choices there that you may not have realized you had. But what about who's the beneficiary of a policy? Now, the beneficiary of a policy is extremely important because this is going to tie in with the holy and unholy triangle that we're going to talk about in just a minute. So, do you think your employer should be the beneficiary of the policy? Probably not, but you want to check all of your beneficiaries to make sure that you have the primary beneficiary and the contingent beneficiary of your choice on the policies you own. If someone else owns the policy, you can't change the beneficiaries because you don't own it. What about your spouse? Should your spouse be the beneficiary? Are you wanting the proceeds to go there? Do you want the proceeds to go to your kids? Business partner, we touched on that before. Do you want the proceeds to go to charity? Who and where do you want this money to go to? Now, on a beneficiary of a policy, that's a little bit different. You could name an unrelated third party or someone who does not have a business interest with you to receive those proceeds. Now, let me give you an example. Let's pretend that I have a life insurance policy and I have my best friend. And throughout life, we've been best friends and everything, and she is like a sister to me. Maybe I have my friend as a beneficiary of those proceeds because that's my heart's desire. I could do that, or I could know someone who was struggling and I just wanted to be a benefactor, and it was a quiet way that I could do that off of my life insurance proceeds. Now, we're going to talk about the difference between a holy triangle and an unholy triangle when it comes to life insurance, and that's generally not a topic you're going to hear a lot about. Did you realize that if you do not structure the policy ownership and beneficiaries correctly, you could create a taxable gift, and the owner of the policy is the one who is going to be responsible for gift taxes? Some of these policies are hundreds of thousands of dollars or into the millions. So you could be looking at a significant gift tax bill to the owner of the policy that we could have very easily avoided. So we're going to spend a minute talking about the 3 points of an insurance triangle. The top point is, who is the insured? Who is the person that when they pass away, the proceeds will be paid out? Who is the owner of the policy? And who is the beneficiary? So we've got 3 points on that triangle. Now, when we set this up incorrectly, that's when we're going to have some of the problems, right? So let's talk about this. Whoever the insured is, whoever the owner is, and whoever the beneficiaries, I need to have 2 points of that triangle match. Now, I could have the owner be the beneficiary and 2 points of the triangle match. I could have I could mess this up if I really wanted to, and I could have the insured be the beneficiary of the policy. Well, think about that. You're not going to be able to receive your own death benefit, so well, that one's certainly not going to work. But anytime I've got 2 points on the triangle that work, the insured could be the owner, but they're not the beneficiary. The owner could be the beneficiary, but they're not their insured. So those are what I want you to understand, the dynamics of that triangle. And that is what keeps those life insurance proceeds tax free. And again, you're going to have a primary beneficiary. You're going to have a contingent beneficiary. I want to talk to you about the owner of the policy if it is not the insured, and you did that for estate planning purposes. If I was the spouse and I owned the policy on my husband and I passed away first, I want to name a contingent owner on the life insurance policy so that new owner can determine who they want to have as the beneficiaries. If I do not name a contingent owner, then the companies, in almost every case I've ever seen, the default language goes to the ownership of the life insurance policy is going to revert back to whoever the insured is. The insured may not want to be the owner of the policy, and then it would have to be sold, or we have to do something else. So if we're going to have an owner who is not the insured, I want to impress upon you the importance of naming a contingent owner so it doesn't revert back to the ownership of the insured. So hope you got that. So point to ponder. So now let's talk about the unholy trinity. And then I'm going to give you a couple of examples. We still have the 3 points on the triangle. We have the insured, we have the owner, and we have the beneficiary. In an unholy triangle, all 3 points of the triangle are different. We have violated the rule of 2 points must match. How would we do this? Let's say that the insured is my husband. Let's say that I am the owner of the policy, and we listed the beneficiaries to be our children. The money will get passed out. But what will happen is I, as the owner of that policy, have now given a gift to my children that is equal to the amount that the insurance company is going to pay out. The children will receive all of the proceeds. I, as the donor, will receive the bill to pay all of the gift taxes when the proceeds exceed $15,000 or $16,000. Depends on when you're watching this video. Let that sink in. When I violate and I do the unholy triangle, then I am creating a gift tax bill for the owner who does not receive one dime of the proceeds. Don't want to do this. Let's talk about another example that I have seen that is a very bad mess up within a company. Let's pretend that you have a policy that is owned by your business. You are the insured. So we have 2 different points on the triangle. You named your wife as the beneficiary. Bam, you have now violated the 3 points of the triangle. It is unholy. Now, the company is going to be the one who is on the hook for dealing with the tax consequences of giving several $100,000 to your spouse out of the business. Yeah, you don't want that one. That's an ugly one. Let me give you one other thing that I'm just going to throw out here. It doesn't really deal with the unholy trinity, but it is a taxable event for you business owners you need to be aware of. When you have buy-sell agreements, or when you have life insurance on the owners within the business that is owned by the company, some of you may erroneously think that the smart thing to do is to deduct those life insurance premiums because it'll save you a little bit on your taxes, give you another little deduction. Here's where it's going to come back and bite you. The law says if you deduct the cost of the life insurance premiums, when the death benefit is paid into the company, you get to claim that as taxable income. You are trading paying a few little dollars of taxes on the premiums by not taking it as a deduction versus paying taxes on a huge influx of cash into your business. Not a good trade. So where it's not the unholy trinity, it's something you business owners need to be aware of. Do you understand why I've made the comment about, is your life insurance policy an asset or a liability? Because you're structuring on how you're naming the owner, the insured, and the beneficiary all have a component where it's going to be an asset to you because you did it right, or it's going to be a liability and it's going to cost you a tremendous amount extra in taxes and hassles. All right, let's talk a little bit about, well, how much life insurance is enough? What does that mean? Well, you know that enough figure is going to vary a lot. Depends on the person, depends on the circumstances. But I have a couple of easy rules of thumb. I usually say 20 to 30 times your annual income. Now, let me break it down to an easy number. And you're going to go, wow, that sounds like a lot. Well, if you make $50,000 a year, times 20 would be $1 million of coverage, times 30 is $1.5 million. Some of you are going to say, oh, I don't even want to be worth that much debt. Well, let me back you up. Let's say that you made $50,000 a year and a person received $1 million or $1.5 million in life insurance proceeds. The idea is that money is going to be invested. And even if it earns a modest return of, say, 5%, $1 million at 5% would generate $50,000 to replace your current wages. And you know what's going to happen over time? Over time, your family's cost of living is going to go up. If you were working at your company and we lost your health insurance, we lost your 401k matching, we lost the benefits, we may need more than your $50,000 salary that was coming into the home in order to replace the items that we have lost. Now, the other thing that can go along with that is, what if you have a family member that you are caring for, or you have a disabled or an autistic child, you have something along those lines, you may need additional amount of life insurance to account for those extra care costs that might be a dynamic of your household. So rule of thumb, 20 to 30 times what your gross annual earnings are. And that's usually a very good amount to get through underwriting. If it is a larger amount that you're asking for, usually you'll need to justify why. Then I may go back to, the care of a disabled child, something along those lines. Maybe you have excessive debt, whatever the case may be, so that the insurance company can see that there is a need for what might be outside the normal ranges of what they would write for. When we think about life insurance, is it an asset or is it a liability? It can be a real asset after death occurs for the survivors. Life insurance, usually you're looking at replacing wages. If you were self-employed, it's replacing your self-employed earnings. Now, for some of you, you have been told that at retirement, you don't need any life insurance. I don't believe that. The reason I say that is because in retirement, I see a lot of couples that rely on both Social Security checks coming into the household. And when one of you passes away, well, the little check's going to go away. And let me explain that little check. When you have Social Security and you have two spouses, one person's going to get a little bit bigger check than the other person. So they've got the bigger check and we got the littler check. Now, if the person who had the littler check passes away, then the big check remains the same, but we have lost the little check income in the household. Now, if the person with the big check passes away, then they give a raise to the person with the little check, but we've still lost the amount that was the little check coming into the household. And what if this is $25,000? Well, in 10 years, that's $250,000 that didn't come into the household. And some of you have pension payments that, depending upon whether you have elected a full life only pension, you've elected a survivorship pension that only replaces 50%, maybe 2/3, maybe 75%, maybe 100%. I don't know. But you can have a double whammy for a spouse if they lose the Social Security income and they also lose a pension income. That insurance may be needed to fill the gap if you don't have the resources to do that. Do you have any type of trust payments that you were receiving that come into the house that cease at your death? We may need to replace that if the family's used to living on that income. Maybe you had parents that gifted you annually, but that's not going to continue forever. What about rental properties? Who did you give those to at your death? I mean, there are so many different components here when you think about income that could cease in a joint household because of death, and each one of your dynamics are different. In those cases, a life insurance policy could be an asset because it is replacing income streams that we need. All right, we've talked a lot about those. So now we need to talk about, well, what kinds of coverage are there? I touched on it briefly. There's group insurance coverage that usually goes through when you are a W-2 employee of a company. There is an individual type of coverage. Now, an individual coverage, well, I own it all by myself, and it's also only insuring one person. Did you ever know that there is a joint life policy? A joint life policy has two persons that are insured on the same policy, but it only pays the death benefit at the death of the second person. So the first person passes away, you still are going to pay the premiums. The second person passes away, now the death benefit is going to be paid. Joint policies are usually used in estate planning situations because it drops the premium down substantially when we have one joint policy versus two individual policies. And we only want the proceeds paid after the death of the second person. So if you're not familiar with that, that's a good solution that we use at times because that works for the scenario. What are some of the basic types of insurance? Well, group insurance is term insurance, and it's just, it's a short term. It's why you're working with the employer. Unless you leave, it's convertible and you're able to take it with you. You can have term insurance. Now, term insurance is usually sold for a level premium for a period of years. And then at the end of that period, it either terminates and you cannot renew, or it changes to maybe what's called an ART, which is an annually renewable term, which means the premiums go up a little bit every year based on your age. Now, a level term policy may have level premiums for 10, 20, 30 years. And with that, as long as it suits your needs, there are a lot of families that in the young years where they are raising young children and their need for life insurance is much larger, they may have a lot of term insurance that kind of coincides with it evaporates about the time the children are, 22, 25, and that thinking that college would be over at that point. There's also what's called decreasing term coverage. Some of you have this and you don't even realize it. If you signed up for coverage with your mortgage, or it had mortgage life insurance, or you paid for the extra on your car loan that you have, if you read it, you'll notice that whatever the premium was, and it may be every month or however that's been taken care of, or it was all paid up front with the policy, then the amount of the life insurance decreases, and it is only equal to the amount of the outstanding balance. Now, if I started out with a mortgage that was $300,000 and then I died 16 years later, it is not going to pay $300,000. It is only going to pay off what the balance of the mortgage is. My spouse will not receive any amount out of a mortgage life policy or out of a policy that pays off a vehicle. Now, one other type called annually renewable term, or ART, A-R-T. Now, this is one that you don't really see very often being sold. Usually it's the level term. But an ART might be something because you think you're only going to need it for a couple of years, maybe, 3 years or 4 years, very short term. It starts out with a very, very low premium. And then each year the premium increases with your age. Again, don't see that one used very often. There's also a couple of basic types of life insurance coverage. If you are looking at those that you want to have for permanent life insurance, or you want to have cash values. Now, those types are called universal life. There is indexed universal life. There is variable universal life. And then you also have whole life. Now, one of the questions that I get on life insurance when you're looking at all of the different types is, well, Amy, what is the best kind of life insurance to have? Is it term? Is it group? Is it universal life, variable life, whole life, ART? What's the absolute best one to get? Let me tell you, in my opinion, the absolute best type of life insurance to purchase is the one that is going to be in force on the day that you die, because that's the only one who's going to pay a death benefit. The other thing I will tell you is, in dealing with families when it's time to collect the life insurance benefits because somebody has passed, I have no one who asks, was that a whole life policy? Was that a term policy? They don't care what kind of life insurance it was. They only care about what's the amount of the check and is it enough to do what needs to be done in the future. So what's the best kind of life insurance for you? The one that's going to be in force on the day that you die. All right. Now you've got the answer to that question. So can life insurance be an asset other than just for a death benefit, which is really the primary purpose of the coverage, and it's the biggest reason that you bought the coverage? Well, permanent life insurance could have cash value. Maybe there are times when you want to take out a policy loan. There are some things that work with that, but if you take a policy loan out, it reduces the amount of the death benefit, and those policy loans do accrue interest whether you pay them back quickly or not. Depending upon the company and the type of policy you have, it may pay dividends, which would increase the cash value. Sometimes policies are set up that the dividends purchase additional amounts of life insurance so that the amount of coverage actually goes up a little bit. Those can come into an asset at times, so that if you no longer needed the coverage and you decided that you wanted to terminate it, you could either terminate it and take the cash value, which may or may not result in a taxable event or taxable transaction. That's a different discussion. Or you may want to take that policy and you may want to sell it to an unrelated third party for more than what the cash value is, with the understanding that this unrelated third party, maybe it's a viatical company, maybe it's a life settlement company, would pay you a certain amount. They're going to keep paying the premiums, and then when you die, they're going to collect the proceeds. Basically, they're gambling that they're going to make a return on their money by buying your life insurance contract. I will tell you that in some cases, you will receive much more out of a policy that you are considering terminating by selling it to an unrelated third party in these scenarios than you will get in the surrender value. I encourage you, because life insurance with cash value is an asset. Term can be if it's got conversions available on it. I want you to seek out professionals. Reach out to me, reach out to someone else to determine what's going to give you the most money back on your life insurance policy. Is it surrendering it directly to the company, or are you much better off financially to sell that to an unrelated third party? Don't miss out on those dollars that could make a huge difference on your future by taking only the surrender option. It can be a mistake. If you don't get any more selling it to a third party, you're still fine. You go ahead with that transaction. Now, the other thing that you can do with life insurance, some people use it as an asset to build a tax-free personal pension plan. Doesn't have to be related to any employer. You can have it just for yourself. You can do this because you have the proceeds and you're looking ahead, and it's an entirely different sessions that I talk about how to control your tax brackets and how to control how the numbers come up on your tax return to reduce your tax liability, just not now, but into the future, and then also into retirement. And it is possible, if you're able to arrange the pieces correctly, to have a tax-free retirement. This is often one of the components that people use in order to do that. Now, with the idea that this is merely an example, folks, you're going to notice I don't have a company name on it. I don't have an age. I don't have a sex. I don't even tell you what kind of coverage it is. I just want you to understand the concept. So quit looking around to see if this might be you. Now, these types of what they're calling, tax-free personal pension plans that are built on a life insurance body has the assumption that you or someone else is insurable and that you have a need for the life insurance. You can put a few $1,000s a year into these, into hundreds of thousands of dollars if you qualify. So there's a ton of flexibility. There's also some flexibility on how many years you pay into it before you would trigger when you start to take out. A lot of that is going to be age dependent and what your timeline is. So now we should be at the slide now. Now let's look at that. Now in this example, we have an individual that had the resource. Let's pretend they sold off a rental property. Let's pretend they received an inheritance. I don't care. They've accumulated the money, but they have the funds and they're looking towards a tax-free income stream later. They have placed in the column 1, $95,000 a year. And I just want you to look at the top line for now. And then at the end of that year, if they decided and changed their mind, you're going to notice the surrender value was pretty pitiful. It's only $4,000. They really want to discourage you from all the costs of underwriting and everything that happens with these policies from just putting it in for a year or two and then cashing it out. The insurance company is going to recover their money, and that's one way that they will do it. But in the first year, if I paid my $95,000 and I died anytime within that first year, I want you to look at the death benefit column on the far right. My beneficiaries that I had named would receive $1,762,025. So I had definitely leveraged that $95,000 into a significantly higher number, right? Now, if we look down a little bit, you're going to see that in this scenario, 1, 2, 3, 4, 5, 6, 7 years in a row is how they had put in the $95,000. And if they had died during any of this time frame, the right-hand column tells us what the death benefit would, and it certainly exceeds whatever they put into the policy. Now, beginning in the 8th year, you see the brackets, 40,616. This is when they started withdrawing money tax-free from the life insurance policy as part of their tax-free retirement income. Now, in that first year that they pulled out the $40,616, if they only pulled it out once and then they passed away, go over to the death benefit column. Our beneficiaries are going to receive just over $2.1 million. And if you glance down at any of the other years, like if we look at the bottom of the page, the very last entry, if they had been taking out this income for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 years in this example, they'd taken out $40,616 a year tax-free for 13 years, the beneficiaries would still receive $1.47 million. So this has worked the way they've wanted. Staff, please go to the second slide. Now, as we look at the second slide, they continued this income for a significant period of years, taking that tax-free $40,000 out. Look at the very last entry there. You're going to see that even though they took out this $40,000 now, in this case, we were what, 13 before, 14, 15, 16, 17, 18, 19, 20, 1, 2, 3, 4, 5, 6, 7, 8, 28 years that they took $40,616 a year out as part of their retirement income, and then they stopped. Look all the way over to the death benefit column. There is still $338,000 of tax-free death benefits available to their beneficiaries. And this was all based on them, going through this is hypothetically, this is an example for you. These can vary a little bit, but this was based originally on them putting in $95,000 for 7 years in a row. So, would this be an asset? I'm going to say yes, this would be an asset because it would pay either a substantially higher death benefit than what the $95,000 would have leveraged. It could have provided a tax-free income and tax-free proceeds to the beneficiaries going forward. I will also tell you, this is a liability. And the reason that this is a liability is that we have committed to a program that we're going to put these amounts of dollars in each and every year for 7 years. And it could be a liability because remember, we talked about the unholy triangle. We definitely want to have this one structured correctly because we're talking over $2 million in life insurance proceeds. That could be a very substantial gift tax bill for someone if it's done incorrectly.